Alright, this might not come as a news, but US is heading into recession. Over the last few weeks, you might have seen alarming signals from major banks and institutions that recession is coming. Earlier this year, during company's earning call, Jamie Dimon, CEO of JP Morgan Chase, did say that due to ongoing war in Ukraine and Fed's hawkish stance on monetary policies significantly increases the chances of recession. Bank of America's chief investment strategist Michael Harnett also said that recession shock is coming. And even New York Fed last week forecasted that there is a 80% chance of 1990 style recession. But before we get to that, it's really important to understand what is a recession. As per Investopedia, a recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial productions, and rising interest rates. There are quite a few ways that can cause a recession, but the three major reasons we can go into recession this year are economic shock, excessive debt, and asset bubble. As you might be aware, there are a lot of things that are going on right now which is harming our economy. There is an ongoing war between Russia and Ukraine which has definitely affected the oil prices across the globe. Here in US, gas prices are up almost 106% compared to the last year and has even reached over $6 in some US states. And this increase in gas prices certainly doesn't help to bring down inflation. And the second reason which can cause recession this year is excessive debt. In the last 2 years, US debt has gone up from $23 trillion to $30 trillion, which is almost 30% up in a matter of 24 months. And this came after Fed started printing dollars in response to COVID. In early 2020, Fed flooded the market by buying at least $220 billion worth of bonds and mortgage-backed securities each month, providing unprecedented support to financial markets, which is also called quantitative easing. I have published a video in past talking about quantitative easing in detail. Please feel free to check it out. I will link it in the description below. But this injection of trillions and trillions of dollars into the economy didn't only push the stock market to all-time high, but also brought down interest rates, which encouraged majority of the people to spend money on things that they don't need, and which also caused a asset bubble. And that takes me to the third major point which can cause recession in this year, which is asset bubble. For example, in the last 24 months, real estate has gone up by 37%, which is definitely not affordable and sustainable. Because by comparison, the last time we grew anywhere this fast was in 2008, when real estate went up by 29% in 24 months. And you definitely know what happened in 2008, right? Well, I'm not expecting something similar to 2008 crisis, as I think we have learned a lot from our 2008 mortgage crisis, and banks now have more stringent measures on who qualifies for a mortgage. But I just wanted to give you an example on how quantitative easing can lower the interest rate, which can cause an asset bubble and drive us into recession. That being said, how do we know we are in recession? Typically, economists call a recession when GDP, which is gross domestic product, declines for 2 consecutive quarters. And there is a committee in the National Bureau of Economic Research that is responsible for officially declaring when a recession starts and ends. And as per National Bureau of Economic Research, a recession can last on an average of 10 months. That being said, US reported negative GDP in the first quarter of this year, which was at minus 1.4%. And if we see a negative GDP in the second quarter of this year, which will be announced in the end of July, then we will officially be in recession. And I repeat, if we see a negative GDP in the second quarter of this year, then we will officially be in recession. And this GDP data is going to be released on July 28th at 8:30 a.m. EST. It's going to be really interesting to see how market is going to react to this. Well, that's it for today, guys. Hope I did provide you some value today. If I did, please drop a like on this video and subscribe to my channel, and see you in the next one.